Well, there's the signal. Good morning, everyone. We'll call the November 10th, 2022 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda this morning is to approve the minutes of the meeting of October 13th, 2022. I have a motion and a second. Please record your vote. Item is approved. Item number 3 is the consent docket. We have one item. I have a motion and a second. Record your vote. Item is approved. Item number 4 is to ratify approvals. We have 3 items. Motion and a second. Record your vote. Item is approved. Item number 5 is to approve the claims docket. Have a motion and a second. Please record your vote. Item passes. Item number 6 is to approve the following applications for service retirement. Have a motion and a second. Please record your vote. Item passes. Item number 7 is to approve continuation to spouse. We have a motion and a second. Please record your vote. Item passes. Item number 8 is to receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. We have one item. I have a motion and a second. Please record your vote. Item is approved. Item number 11 is 9. I'm sorry, I'm getting ahead of myself here. Item number 9 is items for individual consideration. Item number 9A is to approve the ERS pay plan retroactive to July 1st, 2022, and payment of a one-time lump sum individual stipend for you folks that are not with the city. The City Council, as your item in your packet indicates, the City Council back in October approved a 7% cost of living adjustment for city employees along with a one-time stipend. So in that, the ERS employees are identical to the city employees except that they work for the ERS. We brought this forward to afford them the same benefit as the rest of the city employee population. So does anyone have any questions? Hearing none, Chair, entertain a motion. Have a motion and a second. Please record your vote. Item is approved. Item 9B is to receive the monthly investment report. Morning, Jason.
Morning, everyone. I passed out quite a few items this morning. If I won't make you bounce back and forth to all of them. I'm going to hit a couple, but I'll start with this monthly report. If we could talk just about this morning and just look, the S&P's up about 4.5% this morning. The NASDAQ's up close to 6% as we got a inflation reading that was up, I think, what was it, up 0.4, which was slightly, still up, but slightly below the 0.6 that was expected. So treasury yields, 10-year treasury yields fallen 30 basis points, which is from 4.1 to 3.8. This is just this morning. Things can change. That's my point. We're seeing a lot of things happening. But as I walk through, this piece, as we've been doing the last several months, talking about where we are, which is certainly painful on a year-to-date basis, where we've been a little bit longer term over the last 10 years, which has been very good, and then just expectations going forward. And I know you hear me say this every meeting. As a pension fund, you have long-term liabilities. The asset allocation is set up to have a reasonable probability of achieving your required return over a long-term time horizon. We know not every year you're going to get there, but sticking with that game plan is critical. As you'll see when I walk through this, and as you've heard me say, the expectations going forward from today are much better for a long-term investor than they were at the beginning of this year or the beginning of last year, just because asset prices have reset. We came into the year, really came into 2021 and 2022 at all-time highs in terms of equity valuations and sustained historical lows in terms of bond yields. Things have changed quite a bit, where now bonds are actually offering an attractive return for a long-term investor in that kind of 4% range. So on this, if you just turn to I'll skip over that. Why don't we go right to slide 6 here. So this is what, we've talked quite a bit about this year. This is looking at the Treasury yield curve from left to right. Is the very left side of this page is the overnight rate, which when you hear the Fed is raising or lowering rates, that's the Fed funds rate, which is effectively the rate at which banks loan to one another in the overnight market. As you move out to the far right, those are long-term 30-year treasuries. But what we'll see on this slide, the blue or the maroon line at the bottom, that's where treasury yields were a year ago in September of 2021. The green line is where yields are at the end of September of this year. And actually, if we go to today, that Fed funds rate is now up to 4%. As the October meeting, the Fed raised rates again another 75 basis points. But just highlighting, and I see it better in the numbers at the bottom, but if you look at the two-year treasury yields have gone from 28 basis points. So a year ago, if you bought a 2-year government treasury bond, you were getting paid 28 basis points, so effectively nothing. Today, if you buy a 2-year treasury bond, you're getting 4.25%. So almost it's a 400 basis point or 4%, 400% increase in what you get paid for that. What that's done in the meantime, as interest rates have gone up, bond prices have come down. In addition to that, on the credit side, credit spreads, so what you get paid for taking credit risk relative to treasuries, now you have to be compensated more because the yield on treasuries is higher. The yield on corporate bonds and high yield has widened out, meaning corporate borrowers have to pay more to borrow now because other investors could get a higher rate on a less risky treasury bond. And that's also pushed down corporate bond prices. But on a go-forward basis, buying new instruments today, you've heard us say this before, if your time horizon for your assets and your liabilities is longer than the duration of your fixed income portfolio, you're going to be okay when rates rise. And your time horizon for a pension fund is presumably presumably an infinite time horizon. I mean, we're looking out over the next 75, 100 years as you have new employees come in. So the duration on your bond portfolio is today about 5.5 years. So as rates have risen, while it's been painful in the short term, longer term, that should be more beneficial. If you just flip to the next slide. This is kind of the mirror image of what we've shown you the last couple of years in terms of equity valuations. As we talked about at the beginning of this year and the beginning of last year, when we do asset allocation work, saying the expected return on this portfolio is somewhere over the next 5 to 10 years going to be in the 6 to 7% range. And you've been very thoughtful in lowering your required rate of return. When we redo capital market assumptions for 2023, our expectation, and just looking at where we are, we had a meeting earlier this week and we have an investment committee meeting tomorrow internally to almost finalize our 2023 capital market assumptions. It's looking like we're going to be moving the intermediate term assumptions, which is the next 5 to 10 years, across the board are going up 2 to 2.5%. Long-term assumptions don't move around quite as much because they're anchored more on long-term historical, but those intermediate term assumptions, you'll recall, the next 5 to 10 years, are anchored more on current yield and current valuation. So what this is showing is that as of 9/30, the S&P 500 index is now finally in line with the 25-year historical average in terms of valuation and probably going down a little bit below. The expectations are earnings as we potentially move into a more challenging economic times. The job front continues to be good. That's why people aren't saying we're in a recession. But as we're seeing a number of technology companies laying off thousands this week, you're hearing, we could see some earnings, downward earnings revisions, which would bring valuations in a little bit more. So if you go to the next slide, this is what I was talking about, the shaded area that you see there on all of these asset classes. That's what the estimated change to the forward-looking capital market assumption for each of these asset classes would be based on yields and valuations at the end of September. The simplest to understand is bonds. As I just showed you, just the yield on bonds has, if we look at just the 2-year, gone from basically nothing to 4.25%. Core bonds, which is in broad U.S. investment grade bond market, that's a duration of about 5.5 to 6 years. The expectation on that now is pushing 4%, whereas at the beginning of this year and last year, we were below 2% at about 1.5, 1.75%. So pretty dramatic move up in expectations. On the equity side, you see all of our equity expectations are up a little bit more. I'd say small cap and international, small cap and private equity, those are some pretty big bumps that we're having further discussions on. It's really tied to the PEs, and valuations have come down quite a bit, but there's a lot of noise in the earnings with small cap companies because there's about a third of the index, the small cap index, are non-earning companies, so that creates some noise there. I would expect that to come down a little bit, but still up substantially. So the point of this, again, as a long-term investor, looking out over the next 5 to 10 years, it's a better story today than it was at the beginning of this year. If you go to the next slide, this is just looking more near term, and this is hard to predict. I was actually a little bit surprised at this. We've shown you a slide this year probably a few times just to show intra-year, if we went back 40 years to 1980, on average, the S&P is down at some point during the year, on average 10% or more every year. You have that drawdown. But what this is showing is from on a calendar year basis, there's been 4 calendar years since 1937 where the S&P 500 has been down greater than 20%. That surprised me a little bit that it's only 4 calendar years. And honestly, where we're setting up right now, I'd be surprised if this year we were down more than 20% on the S&P 500. We're down through yesterday 20%, but it's up 4% today. Generally, the last couple months of the year are better months, but that kind of ties to this. But what this is showing is in those years where we're down over 20%, the following year, you've been up more than 20%. So again, just a reminder about sticking with your knitting, rebalancing as appropriate, not reacting to what's happening in the market, and sticking to that long-term plan. As we look at your portfolio, just hit on a couple things. Where we stand today, we're roughly pretty close to in line with targets, a little bit underweight to equities, a little bit underweight to fixed income, and slightly overweight to real estate. If we add the cash back in to fixed income and cash, which the cash is pretty transient. You don't hold that for a long time, but we're raising a little bit more now. You generally raise about a quarter's worth of cash. It's no longer a drag. You're getting close to 3% on that cash in your sweep funds at the bank. So you're roughly in line with the targets. A little bit overweight to real estate, which we've put in a redemption there. On the equity side, U.S. equities, large and small, a little bit overweight, slightly underweight on the non-U.S. equity side, as that's not done quite as well. And then private equity, which we're building toward that target. The total fund, if you just look at the next page, you see the month was a strong positive month. We trailed a little bit, but the portfolio in October was up 3%. Equity markets, small cap led the way, up 9.5% for the month. Your small cap was up almost 11.5%. U.S. large cap up 8%. Your large cap outperformed, up 8.2%. The drag now is when market snaps back up that much has been long short equity, and actually private equity. We're starting to see private equity, which has held up. It's not mark to market on a daily basis like your public markets. That looked really good as public equities were going down. We're starting to see what's happened in the public markets kind of flow through to private markets, where your private market managers are marking down assets in their portfolio to reflect the current environment a little bit more. We don't expect that, and you'll see that in this private equity portfolio review. We don't expect to see private market assets have the same experience as public markets, because generally what happens, public markets bounce back before it's fully reflected in your private equity investments. In addition, your private equity portfolio is fairly young. Most of your commitments have been in the last few years, so you're not experiencing what others may be in their private market portfolio that have a lot of capital in the ground that they invested in 2013, 14, 15. You've made a lot of commitments the last couple of years. So overall, on a trailing one-year basis, down about 13%. Policy index down a little bit more. I'd say roughly in line. The one thing I will point out, this month, the transition between Times Square, small cap growth manager that had quite a bit of turnover in the team, we made a decision to replace them with Silvercrest. That transition was completed during the month. We used Northern Trust transition management services. So the securities in the Times Square portfolio were put into a transition management account with Northern Trust. Silvercrest identified what securities they wanted to have afterwards so that we weren't out of the market, which it turned out to be a good thing in a month where you had the market up quite a bit. So we really minimized the time out of the market, and overall in a month where you transitioned about 45 million of your small cap assets, the composite overall outperformed by about 2%. Just, you don't have to open this up, but you all have the quarter book, and I'll just point out from a peer group standpoint at the end of September, this is on page 24 of the quarter report. I don't know how quickly you can move to that. But, So in addition to relative to objectives, relative to your policy benchmark and your required return objective, we also compare the portfolio to peers. This portfolio continues to perform very well relative to peers. We're comparing you to two different peer groups. One is a more risk-based peer group that in IM, which stands for Investment Metrics, it's the data provider of funds between 55 and 70% in equity. So this would include public and corporate pension funds, endowments, foundations. It's a much more robust group of institutional investors that have between 55 and 70% in equity. So it's similar, it's a pretty wide band, but a similar risk target. They're not shorter, not more conservative type portfolios. And then we also compare you to other just public pension funds. Those numbers where it says rank, those are the ranks in those peer groups. So on a 3, 5, and 10-year basis, I'd say you're in the top decile on a 3 and 5-year basis versus other funds with a similar risk appetite, and in the top quartile versus public funds. And over a 10-year basis, similar in the 30th percentile versus all public funds. So very good performance relative to peers. So sometimes we think, well, right now it's bad. How do we look relative to others? This is what this is showing us. Any questions on the portfolio or current performance?
Yeah, I just had one question for Jason, maybe a comment and a question. When we were looking at the recoveries, you know, on down markets over the trend time, we all know that, yes, this too will pass. You know, we'll get through this. But as far as expectations of when that comes, and there again, it's just expectations is what I'm asking about. Seems like it might be a little bit different now that we have supply chain issues that, you know, in manufacturing of vehicles and all kinds of things. It just seems like it's hard to get things started because even if you wanted to, you can't. You know, we just don't have the supplies there to get it. Is it reasonable to expect that that might make that return or that turnaround just maybe a little bit more delayed than what we have seen in the past?
Certainly that's reasonable. I mean, we can't predict when things will turn around. You know, I think the data that we're showing is just to remind people that things do turn around. We don't go down forever. And longer term, you know, as an investor that needs a 7+% return, having equity risk in your portfolio is necessary to get there. And we can't really time or guess when you're gonna be paid for that or not paid for that. So sticking with that plan is critical. I think there's probably, I don't think what we're seeing today, and that was why I started with what I did, an inflation reading that is 0.4 versus 0.6 positive means we're at the end of the issues that we're having right now. I think there's probably still some pain to go, and certainly going to see that on the economic side and the economy and earnings. So I don't think it's unreasonable to expect either some muddling or some sideways returns or even another downturn. The degree of the downturn I don't think could be what we've already seen. There's been a lot of value taken out of the market already. We've got still through yesterday, growth stocks are down 30% on a year-to-date basis. That's a pretty big decline. So, I mean, I don't think we've got another 30% there. So we did have one other item, which is the private equity portfolio review and recommendation. So as I pointed out, you have a 10% target to private equity in your strategic asset allocation. We actually bumped that up from 5 to 10%. I think it was in 2020 now, and it just takes some time to get there. As you all know, these investments different than investments in long-only strategies in that we don't just take dollars and move them into the private equity funds. It's done through a commitment process where you make a commitment to funds that are newly created. They will draw down your commitment over the next 3 to 5 years and invest that in companies. And then over the 10-year life of that fund, so typically beginning in year 4, if companies that they invested in year 0 or 1, as those are maturing and they've improved them, they sell them and they distribute capital back to you. So to get to your 10% target and maintain it, it requires a constant, continual feeding of that machine. And so we go about that through a review of your portfolio probably every 6 months. Sometimes it may seem more frequent as compelling opportunities come along. We're trying to build a private equity program that is diversified by type and economic cycle of what they're investing in, and diversified over time through when you're putting money to work. If we just turn in this slide to the slide 5, this is kind of where we've been in the last decade. It's been in the different types of private equity. We start on the left with buyout and growth, which are more mature companies. Sometimes buyout might be more turnaround. Growth equity, you have a lot of what we would consider growth equity with Warburg Pincus. That's one of your foundational investments. Venture capital, think more early stage, technology, healthcare, biosciences. Private debt, we're not really doing private debt in this portfolio, but we're showing what those returns are. If we look at the last 10 to 15 years, buyout and venture capital has actually done better than the S&P. If we looked at this 6 months before, this is as of March 31. This date is a little bit lagged, but if we looked at it 6 months before, it was comparable. The spread between the S&P and buyout and venture was a little bit tighter because we've been through such a good period in the S&P 500. The other point to make on the next slide is that things do move around. Well, this is looking more at currently, and you're seeing where what we're seeing the first 6 months of this year is valuations coming down a little bit. You haven't really experienced much of that in your portfolio, as I mentioned, because your portfolio is a little bit younger in terms of when you've put dollars to work. You still have quite a bit of unfunded commitments, so you're not getting that drag that some folks that had money put to work in 13, 14, 15 might have had. But you'll see this is through June 30, which is really September, because those values are dropping. September, you get June 30 marks. Buyouts down about 3.5% on a year-to-date basis. Venture about 12.4, and growth equity down 10.4. This is the broad market. Your portfolio on a year-to-date basis, nowhere close to that. The private equity is actually year-to-date down 4.45, so about in line with buyout overall, so holding up fairly well. Moving on to the next slide is just a quilt chart as a reminder as to why we try to allocate across different types of private markets, because what is good in one year isn't always good in the next. But the last decade, if you will, venture capital has been the best performing area, followed by buyout. Distressed is an area that is more cyclical, more opportunistic. You have participated in some distressed opportunities over time. Actually, your first commitment in 2008 was to a distressed fund or 2009, coming out of the financial crisis. You made a commitment to the Sigler Guff Distressed Opportunities Fund. And they're more opportunistic in taking advantage of dislocations in the market. We also made a commitment to the Carval Fund in 2020 at the mid-2020 during COVID, thinking that there was going to be a pretty ripe opportunity in distress, which really didn't materialize. They haven't put a lot of capital to work. We think there's going to be some opportunity for them going forward to continue to put capital to work that you've committed to them that they haven't invested yet. And there'll be their manager that's going to be back in market later in 2023. So then just looking at your portfolio and how have you done, your portfolio has done very well. So we're comparing your private equity performance to public markets. We use a statistic that we call public market equivalent. And effectively what that is that if we took the dollars that you are, when they're called, when you are taking dollars and putting them in into your private equity portfolio, or dollars coming out, if we were to put those into the S&P 500 or the MSCI ACWI, how would that perform, putting them in at the same time? Because that's the difference with private equity and public markets. You don't control the timing of when money goes in and comes out, so we have to calculate a little bit differently. Since inception, and this goes back to 2009, your portfolio your private equity portfolio has generated a 15.3% return. That's over there on the right. And that compares very well to an S&P 500 plus 250 basis points, plus 2.5%, which is what we would say the illiquidity premium is that we should be shooting for, is about 2 to 2.5% for that illiquidity, and we're right there. Compared to a global benchmark or the MSCI ACWI, about double that return. 3, 5, and 10 years, well above those metrics. So overall, it's doing what we would expect. As a long-term investor, a pension fund with long-term liabilities and more than sufficient liquidity, meaning more than sufficient other assets to pay your bills and benefit payments on a monthly basis, you have the ability to give up some liquidity in your portfolio to try to generate a little bit higher return through investing in private markets, and that's what we're doing here. Next slide, this is from your report, and this just shows going back to the beginning, each investment, Mesirow and Sigler Guff, your first two commitments in private equity, these were both fund-to-funds. So Mesirow was a diversified fund of funds that invested across all of those different asset types: venture, growth equity, buyout, some secondary, and distressed. Sigler Guff was a dedicated distressed debt fund. And then we began really in 2012 pivoting in a way based on your size. We felt that you had the ability to take out that second layer of fees and somewhat of that over-diversification and just invest in direct funds. So beginning with Warburg Pincus Fund 11 through what the last commitment you made this year, you'll see some of those don't have dates, those last 4, and that's because you'll see the commitments and the drawn to date. There's nothing been drawn yet, so we don't start the clock on performance on those until they actually draw down capital, if you will. Overall, the top line, since 2009, you've committed $124.5 million to private equity funds. $74.3 million has been invested. You've got about $51 million remaining commitments that you've made that haven't been invested yet. Almost $60 million has been distributed back to you. So that's either been recycled back into the private equity program or used to pay benefits or other things. So the total value of your private equity investments, for every dollar you've put in, you've got $1.73 in value today. The next slide just shows some diversification across 2 different metrics. One is by strategy, the other is by time when you made that commitment, and that's really critical here, is because in continuing that diversification by time, because unlike other asset classes, right now, a lot of folks are talking about, well, private equity, you're seeing marks down in private equity, and depending on where you sit, for current investments, that could be a bad thing, but for new investments, it's a good thing, because you were able to put money to work at a much lower valuation or price. So generally, what we've seen over time is money committed to funds in challenging times or recessions. Those vintages, those years, tend to be the best performing vintages when we look back into the future. What this is highlighting, though, about 64% of your portfolio in terms of strategy is growth equity and buyout. A significant part of that growth equity is Warburg Pincus. As you'll see when we lay it out kind of on this bubble chart, Warburg Pincus is a global private equity firm, and they're doing a lot of different things. They are doing some buyout, they might even do some turnaround. Most of what they're doing is growth equity, so it's more mature companies. They're not buyout or turnaround, but it's much more stable than early stage venture, what you're doing with Firstmark, for instance. So I'd say most of that, 64% of the portfolio is kind of in the middle of the risk-reward spectrum. In terms of time, you'll see that a significant portion of your commitments have been made, 70% between 2019 and 22. A big part of that math is you increased your target allocation from 5 to 10%. So when the allocation went up, just effectively more dollars were committed because a bigger percentage of the portfolio, and your portfolio is much bigger. 10% of the portfolio in 2020 is much, or 2022 is much more than 10% of the portfolio was in 2008 or 2009. So that's what's driving those numbers. So here's what the portfolio looks like today in terms of if we plot it out. Firstmark, more venture-oriented, seed and early stage venture capital. Warburg Pincus kind of crossing over from growth equity to buyout. Francisco Partners, there in the middle, it is more buyout, small and mid-market. They are more sector focused on technology. Apollo was a foundational investment that you made back in 2000, what was that? 2015. Buyout, some distressed, more turnaround, and then Carval on the distress side. We still like Apollo. There's a lot of, in terms of relative performance, they've done fine. Just a lot of news around the firm that we think we can avoid with other quality groups. And CD&R, Clayton, Dubilier, and Rice is the firm we're bringing to you today. This would be a new firm for you all. They're a group that's been around for over 30 years, highly successful, focused on mid to large market buyout strategy. They do some healthcare, but relative to what you have in your portfolio today, more industrial, business services, and some healthcare. One of the big names that you might recognize is Safelite. I don't know if anybody's I had a son that played baseball, so we had a lot of broken windows at parking lots and got to know Safelite repair, Safelite replace, the little jingle. Well, they took that company public. It's an insurance and car repair type company. The next slide is just revisiting the pacing model. So this is, you've seen this before. There's a whole bunch on here of numbers where we're making various assumptions on your existing portfolio, and then on a go-forward basis, how much we need to commit per year to reach that 10% target and maintain it. This model, we talk to all of your existing managers to kind of get a sense of if things are being delayed in terms of distributions, if we think that market's going to slow, and you'll see 2023, we're actually, for projected distributions, it's a small number relative to the further out years because we think the market is a little bit more challenging right now for companies to be sold. The blue line at the bottom of that page is showing where we're currently at. We're trying to get to 10%, and we know it's going to take some time to get there. We don't want to overshoot it too much. So what this model is telling us is you can afford to commit $20 million a year to private equity to get to that 10% kind of in 3 years. And if we overshoot it a little bit, we'll be at 11. I know there were questions the last time about this being what if something changes and we're still putting 20 million out in 2026 and 2027? That's not what this is saying. This is today, based on the planning we're doing today, what our target is, how much can we afford to put to work in the pacing plan to get to that 10% target without going too far over. And today it's 20 million. I handed out a loose piece of paper just to show you, and I slid it in each of your books because I thought this was helpful. This is showing how that pacing plan changes. So this isn't set in stone. What this is showing is the pacing plan that we showed you in December of 2020 when we made prior recommendations. That's the light blue bar. The yellow line, the yellow dotted line, is the target of 10%. So we're just showing that, and that 10%, we're not showing the total value of the portfolio, but that 10% on a dollar basis is changing. 10% of your portfolio today is less than 10% of your portfolio was in December of 2022 because values have come down. So what's happened is that pacing plan, we've adjusted it by about 15 million a year. So this is really intended to show that this is a dynamic process. We're not locking in these numbers, but today we had to make some decisions about what is reasonable to commit. It's about $20 million a year and 2 commitments. This could change, and it will change. If we go up, if the portfolio grows back to $1 billion, these numbers are going to go up. But we don't want to, we have to constantly revisit this to make sure we're not overshooting things. Page 14, just looking at our pipeline, other things on the horizon that we're looking at. You'll see some other names that you're currently in second half of 2023. Carval, Apollo is currently in market. I'd say we're passing on that at this time and making this recommendation of CD&R, which we think is complementary. First half of next year, some things that might be of interest here. We were just listing a number of things. TA Associates is a very capacity-constrained growth equity manager, very strong historical track record, much like a Warburg Pincus. It's been very hard to access that fund. There may be some opportunities in this market environment to get access. I'm not sure that we need that in this portfolio. Bernhard is a small to middle market buyout, service-oriented. They're targeting companies in the $5 to $10 million range. So we've got a lot of the larger buyout that we're getting through a CD and Clayton, Dubilier, and Rice, assuming we do that, and Warburg and Apollo. They would be a little bit smaller market. Oaktree, a distressed debt manager, depending on the distressed opportunity, could be an attractive one. And then certainly Carval, which you already have a relationship with. This is simply just to show kind of the forward-looking pipeline that we're thinking about this. These are opportunities on the horizon. So now moving to Clayton, Dubilier, Rice, Fund 12. I'll go to page 16, if you will. I'm sorry. Thanks, Mike. So this is their Fund 12. Their first institutional fund goes back to the mid-90s. This is a very large private equity firm, over 185 employees across the U.S. and Europe. They're focused 5 core verticals: healthcare, technology, industrials, consumer and business services. I kind of describe some areas where they focus. This fund is going to be $20 billion. We expect it to be slightly oversubscribed, even in this pretty difficult fundraising environment. Their average company size that they're investing in companies that are half a billion to $1.5 billion size companies. So these are, if they were in the public markets, they'd be micro to small cap companies, which is what we what we would expect. Initial closing was in August. We expect the final closing of this fund to be in January, so we're pushing up against the end of the term. Probably have 20 to 25 underlying companies invested in it. The next page, you'll see kind of where they've focused, which are these core verticals: industrials, consumer, business services, healthcare, and technology. Technology has grown a little bit more recently, as that's what's grown in the market, but certainly a pretty significant allocation to these other areas. Page 18, just performance. Again, we're looking at the performance of their funds going back to 1996, Fund 5, versus public market equivalents. Very strong performance, with the exception of Fund 5 was, that was a fund that was put to work before the tech bubble, and then they had some decline in the tech bubble there. They were up about half as much as the S&P. Every fund since then, very strong returns relative to the public markets. And the next slide, relative to peers, you'll see there in the upper right in that table, on a number of metrics, TVPI is total value paid in. So for every dollar put in, how much are you getting out? So their fund 7, 8, 9, 10 are all first quartile. Same with internal rate of return, which is a percentage rate of return. That's how they're generating capital. And then distributions, it's not just unrealized. They're actually distributing money back to their partners, which is something that we want to see. You might have a great, on recent vintages, total value or IRR, but if it's not realized, your investors aren't getting that money back. They're finding a way to get that money back to their investors, and they're in the first quartile. So very good relative performance to peers. So in the end, we think, I guess back that bubble chart, they would fit nicely and be a nice complement on the buyout, later stage buyout, really to what you have with Warburg Pincus today, a surrogate, if you will, to Apollo, which we're passing on at this point. We think CDR is a better opportunity right now, and we're recommending a $10 million commitment to Clayton, Dubilier & Rice Fund 12.
Does anyone have any questions of Jason? Okay. Hearing none, we've got to double back. We've got to approve these items individually. So I don't have my agenda. It's right in front of me. Item 9B is to receive the monthly investment report. I have a motion and a second. Please record your vote. Item is approved. Item number 9C is to receive the quarterly investment report. A motion and a second. Record your vote. Item is approved. Item number 9D is to receive the private equity portfolio review and recommendation. I have a motion and a second. Please record your vote. Item is approved. And last but certainly not least, item 9E is a commitment of $10 million to Clayton, Dubilier & Rice Fund 12. Motion and a second. Record your vote. Oh, I'm sorry. I'm getting ahead of myself. Here we go. technology. There we go. Have a motion and a second. Please record your vote.
I'm showing that it's waiting. Approve.
There we go. Item is approved. Okay. Okay. Thank you, Jason,
Thank you all.
very
Sorry.
much. It's very informative. Good update,
Thank you.
as usual. Okay, item number 10 is comments from board staff and citizens. Hearing none, we are adjourned at 10:51. Thank you, everyone.
I have some copies of my latest book that are on my drive.
Just, Amy, just X out up here
Yes, sir.
and then go down.